Hello, my name is Ruben Chico, and I am part of the BRE-126 course, which is entitled Real Estate Financing, and is being taught by Professor Regina Brown. Today I will be speaking on Chapter 10, which is entitled Alternative Financing. Now, I will give you a little background on how the name alternative financing came into existence. In 2008-2009, we experienced a real estate housing crash. At this particular time, the normal banks started to become very stringent in their loan qualification guidelines. They essentially stopped lending money. But people needed to borrow, so private lenders stepped up to the plate. These private lenders are called alternative financing institutions, and they set their own qualification guidelines. These lenders can specialize in any field they want. Some can specialize in auto loans, some in consumer loans, some in business loans, some in home loans. They do what they want, and they finance who they choose to finance. Now, these alternative financing lending institutions take place through online platforms today that use technology to bring borrowers together. And these borrowers may not qualify for just an ordinary bank loan. So there are advantages to alternative financing. Some of them are a simplified application. So simplified application in this sense means that it's easier to qualify. The loan process is a lot faster, so you get your money quicker. And a lot of times that's necessary when you're doing business. There are more loan options. The rates are higher. Sometimes that's an advantage, and sometimes you just have to suck it up and pay more. And you're paying for what you get. The loan terms are shorter, which means that the payments are more frequent and your loan gets paid off faster. So alternative financing is a good resource if you need money quickly. Now, with every loan comes a loan process. And what this means is that the loan process fee must be paid on the loan amount. The money borrowed has an interest rate. So I'm going to introduce you to something called discount points. So I'm going to try and do this mathematically. A point equals 0.01. 0.01 equals 1%. So let's go back to the loan processing fee. If a mortgage originator is going to charge a loan processing fee and he's charging you 2 points on a $100,000 loan, he's going to charge you 100,000 times 0.02, which equals $2,000. That simple. He's charging you $2,000 on the loan process. Now let's go to the money borrowed, the money that has to be borrowed in order to purchase a home. Let's go back to the $100,000 example and figure out what the discount would be on that particular scenario. So if you're being charged 6 points, you would take $100,000 and you would multiply it by 0.06. And that would be $6,000. How does this help you? So you take that $100,000, you subtract $6,000, and now your loan is $94,000. What happens here is that you're not financing $100,000. You're financing $94,000. Because you paid that $6,000 and brought the loan down, the lending institution will give you a discounted interest rate. It could be at 6% originally, but because you paid that $6,000 at closing, you are now being charged 5%. That's a discounted point system. Thank you.